Hey there, I'm Jeromy, and today we're diving into something that every smart investor in Australia should know about. The top 5 investment accounts that offer real, legal tax benefits. Taxes can eat into your investment returns, but if you use the right accounts, you can significantly reduce your tax bill and build wealth smarter. So whether you're just starting out or already growing your portfolio, this video will give you the lowdown on the most tax-efficient places to put your money in 2025. Let's get into it. Section 1. Superannuation account. Number 1 on our list, and arguably the most tax-advantaged account in Australia, is the superannuation account. Super is your retirement fund. You can think of it as a long-term investment vehicle that comes with some serious tax perks. Here's how it works. When you or your employer contribute to your super fund, those contributions are taxed at just 15%, provided you stay under the concessional cap, which in 2024 to 2025 is $30,000 per year, or more if you're eligible for catch-up contributions. Compare that to your marginal tax rate, which could be 30%, 37%, or even 45%, and you can immediately see the savings. The earnings inside your super fund, like dividends or capital gains, are also taxed at just 15%, and if you're in pension phase in retirement, the tax on earnings becomes zero. So you're getting lower tax on contributions, lower tax on investment earnings, and zero tax in retirement if managed correctly. Why doesn't everyone just max out their super? Well, super is great, but your money is locked away until you reach preservation age, usually somewhere between 60 and 65. That makes it ideal for long-term retirement planning, not short-term goals. Still, if you're working, saving, and thinking long-term, this is the single most powerful tax shelter available in Australia. Section 2. Investment bonds. Number 2 is a lesser-known gem, investment bonds. These are not government bonds. Investment bonds are actually long-term investment products offered by insurance companies, and they come with a unique tax treatment. Here's what makes them powerful. When you invest in an investment bond, all earnings within the bond, including dividends, interest, and capital gains, are taxed at a flat rate of 30%. But here's the kicker. If you hold the investment for at least 10 years and don't withdraw money during that period, then all the earnings could become tax-free to you as the investor. That's right, you don't pay any extra tax on withdrawals after 10 years. It's especially useful if you're currently in a high income bracket, want to save for a child's education, or are planning for long-term goals outside super. Other bonuses? You don't need to declare yearly earnings in your personal tax return. Can be transferred between generations more easily. The rules are strict, so make sure you follow the 10-year rule and stick to the 125% contribution limit annually. While not as flexible as regular investing, investment bonds are one of the few legal tax shelters outside super. Section 3. Discretionary trust. Coming in at number 3 is the family trust, also called a discretionary trust. This structure isn't an account, but it's an incredibly powerful investment vehicle for people looking to grow wealth while managing tax across family members. Here's the key benefit. A family trust can distribute investment income, like dividends or rent, to different beneficiaries in your family based on their income levels. So, if you have a non-working spouse, adult children over 18 with low income, parents in lower tax brackets, you can legally distribute income to them and reduce the overall family tax burden. In some cases, income that would have been taxed at 45% in your name may end up taxed at 0% or 19% in someone else's. Key points. The trust itself doesn't pay tax. The beneficiaries do. You must prepare annual trust distribution resolutions. You need good accounting advice to set it up properly. But used right, this structure gives enormous flexibility and can save families tens of thousands in tax. Just remember, this is not for beginners. You'll need a trust deed, ongoing admin, and compliance support from an accountant. Section 4. Offset account for property investors. Number 4 is for the property investors out there, and that's the offset account. This is technically a feature of a mortgage rather than an investment account, but when used smartly, it becomes a powerful, tax-efficient cash management tool. Here's how it works. An offset account is a transaction account that's linked to your mortgage. any money sitting in that account reduces the balance your interest is calculated on. So, if you have a $500,000 loan and $50,000 in your offset, you'll only be charged interest on $450,000. Why is this tax efficient? Because the money you save on interest is tax-free. Unlike a savings account where interest earned is taxed at your marginal rate, reducing your mortgage interest is a form of return that isn't taxed. It's perfect for people who want access to their money but still want to grow wealth efficiently. Tips: use your offset account for emergency savings, short-term goals, or to park business cash. Better than paying off your mortgage directly if you want flexibility. It won't make you rich on its own, but it's one of the smartest low-risk tax moves you can make as a property investor. Section 5. Share trading account in your personal name. Long-term CGT strategy. Finally, number 5, and this might surprise you, is a regular share trading account in your own name if you use it with a long-term capital gains strategy. Why? Because Australia offers one of the most generous CGT concessions in the world. If you buy shares or ETFs and hold them for more than 12 months, you qualify for the 50% capital gains tax discount. So if you sell shares for a $50,000 profit, only $25,000 is added to your income. Depending on your marginal rate, this could reduce your effective tax to as low as 11% to 22% on that gain. Now, this account doesn't give upfront tax savings like super or a trust, but it's simple, flexible, and extremely efficient if you're investing long-term. Other advantages: no admin or legal setup, full control over buying and selling, works well for building liquid wealth. It's also a great complement to the other accounts we've covered today. So, those are the top 5 investment accounts that offer tax benefits in Australia. Superannuation, best for long-term retirement wealth. Investment bonds, ideal for long-term savings outside super. Family trust, great for income splitting across your family. Offset account, hidden gem for property investors. Share account with CGT discount, flexible and efficient for long-term investing. Which one is right for you? It depends on your goals, income, time horizon, and how hands-on you want to be. Most savvy investors end up using more than one of these to build wealth strategically over time. Let me know in the comments which of these accounts you already use, or which one you're thinking about setting up, like if this helped. Subscribe for more investing, tax, and small business tips, and I'll see you in the next one.